Well, hello friends. I hope the markets are treating you well, and from the kind of feedback that I have received from my online family, it seems the Hacienda hedges that I have been advocating have really turned out to be lifesavers and more. Now, in this week's video, I want to discuss why the markets are falling, how long they can potentially fall, and how you can take informed decisions on your own about what to make out of what is happening. As per the cause and effect theory, if you know the cause, you will know what the effect is, and only then will you also be able to know how long the effect will last. So there is a special segment at the end of this video. It's as you know, these videos are divided into chapters. The title of the chapters is Why Are Markets Falling? Please do make it a point to watch this chapter carefully. Also, a small announcement here for those of my online family members who find it a slight challenge to understand the message in these videos because they are recorded in English. If you actually were to use the tools made available to you by YouTube, now if you at the bottom right hand side of the video, click on the settings button on your web browser, you will see that a small pop-up window opens. There you can enable your subtitles in the language of your choice and thereby make a better sense and sensibility of what I'm trying to say in these videos. That done, let's dive right ahead into the weekly market roundup window coming up on your screen. And as you can see, it was the markets that fell almost uniformly, with the broad-based Nifty 50 and the Bank Nifty falling in equal percentage terms. The US dollar index fell. Now that should have been good for emerging markets including India, but it was not. The reasons are in that second last chapter titled Why Are Markets Falling? Now gold and silver also fell. I'll explain later why. Oil fell 8%. No surprises there. I've been telling you to the absolute perfection as to why I don't think there is any super cycle in any commodities. Forget about energy. So here we are on the ball, and the only reason why natural gas has risen is because this is a cyclical time in winter when gas is used for heating indoor in the Western countries, and therefore prices tend to go up. It's more of cost of carry rather than price appreciation. The USD INR is kissing lifetime highs at 84.01. This is another one of those worries why Indian markets are slightly under pressure, because a strong dollar means imported inflation. The Indian 10-year benchmark bond yields more or less unchanged at 6.85, just fell by 1 basis point. NSE market capitalization lost a little under 1%, which means the selling was fairly broad-based. MWPL went to 38.11, thereby gaining a little over 6%, which is routine after expiry. The US market headline indices fell, with the Nasdaq being the biggest loser, followed by the broad-based S&P 500. So the US market provided headwinds for our markets here. Friends, I now come to the ratio chart, the Bank Nifty divided by the Nifty 50. This tells you that the Bank Nifty lost ground against the Nifty 50 yet again for the fifth week in a row after a very brief hiatus. Now, a word of caution here. It may be possible, just like you saw last week, that the Bank Nifty and Nifty fell in equal measure in percentage terms. Now, when that happens, the Bank Nifty versus the Nifty ratio chart might just start flatlining. That's not a cause for cheer. It's basically telling you that both are plunging together and the percentage change or correlation coefficient has gone flat. It doesn't mean that the markets have started to rise. Do keep that in mind, please. Now, friends, I come to our in-house indicators. I start with market-wide position limits. In my humble opinion, this is one of the most important metrics that you can use out here. Not too many people assign it the kind of importance that this indicator deserves. The reason being, from a behavioral finance perspective, this indicator tells us the commitment levels, both in terms of emotional commitment and in terms of financial commitment. And the commitment levels have frankly gone up extremely fast to 38.11. Now, this is the fastest clip at which this MWPL has risen 1 week after the expiry related decline. That tells me that retail guys, unfortunately, are being emotional. They are continuing to buy the dips just because they become habituated of saying, okay, the market falls for a day, 2 or 3 days, but it only bounces back. So that is a kind of presumption that might not be a very healthy thing to do. You need to keep tail risk hedges in place. I remind you that I have been telling you high MWPL will lead to high beta or volatility, because when positions get built up and adverse news comes in, people tend to square up larger lots, leading to bigger price moves. Friends, I now come to the stock and index futures turnover. Remember, these are 3 concurrent series, so it's September, October and November. Expectedly, the turnover went up in the week prior because of expiry, and then the post-expiry week saw a decline. Now, this decline has been fairly sharp, as it has been in all prior instances after expiry. So, nothing much to read into this situation. Now, friends, I come to the advanced decline ratio after the price. This is the most leading indicator itself and a good barometer of which way the winds are blowing. The advanced decline ratio was 0.98 in the week prior, but it has plunged even lower to 0.85, which means for every 100 losers, there were only 85 gainers. Now, one Marshmallow traders or intraday traders were showing very poor risk appetite, and that's not really a great sign. The Marshmallow theory is explained in a video, the hyperlink to which is in the description below this video and in the pinned comment below. Friends, I now come to the Nifty and Bank Nifty prompt month futures, where I see the basis. Basis is nothing but the premium or discount that the futures are enjoying vis-a-vis cash. Last week, I remember telling you that the extremely high bases that both the Nifty and the Bank Nifty were logging were not maintainable as per the statistical history that I have seen in a statistical model, the IBEX. Sure enough, you saw approximately 1/3 of a erosion in basis in the Bank Nifty, and more than half, or maybe even close to 2/3 of the basis being lost in the Nifty itself. Now, that tells you that risk appetite contracted very, very sharply, especially in the latter half of the week. Not exactly a very good sign for bulls. Now, friends, I come to the impetus. Now, these indicators, the impetus and the LWTD after this, are our in-house indicators that you've been enjoying since the last 3 years or more. I have been raising red flags since a couple of weeks, telling you that even if the indices were rising, the impetus was falling. That means the rallies lacked momentum. And sure enough, what you have seen is that the impetus continued to fall on both the indices. But for a change, I think that would be a very marginal plus point, because the indices have logged declines. Even the declines were on poor momentum. But let's not assume that poor momentum is all right in case of a sell-off. In this video up here, I have explained to you why volumes or pressure in downward markets need not be high as compared to volume and pressure in rising markets. Do make a note of this video and watch that, please. Friends, I now come to our in-house indicator, the lift weight thrust drag index, or the LWTD, which is basically showing that the Nifty fell 1.5%, but the LWTD, which was in positive 0.25 in the week prior, has fallen to minus 0.03 last week, which means even at lower levels, there might be a smaller or a milder buying support coming in, both from fresh buying as well as short covering. Sure enough, there will be a churn, but a net buying support might just be a little milder. Friends, our indicators done. I now come to the bond market, which is very close to my heart because this asset class or the bond yields actually funds all the other asset classes. I have been telling you since October 2021 on my Telegram channel and other social media platforms that I'm on that cost of funds are going to go up and there will be fallouts. If you go to my Telegram channel, and my contact coordinates are there in the fag end of this video, in the pinned comment and description below this video, you will be able to read all those reports if you type in the search string cost of funds or interest rate sensitives. So the bond yields are more or less getting to be stagnant at 6.85%. This is exactly what I told you a fortnight ago, that at 6.85%, I'm expecting some amount of semblance of stability. Remember, I'm using the word semblance, not outright stability. Why? Because I do feel some amount of turbulence is still left in the bond yields. And which is exactly why I am still not investing in gilt funds. If and when I do start investing in gilt funds, I will update my Telegram channel. And now we have a WhatsApp channel as well. The hyperlink to that is in the description and the pinned comment below. Please do subscribe to that WhatsApp channel as well. I will be very happy and only too glad to share with my online family whenever I think it's time to buy gilt fund. But hey, it's not yet time. It's premature. Nor am I buying sovereign bonds, 10-year sovereign bonds either, because I think we still are in no man's land. Friends, the bond market's done. I come to the Bank Nifty, which lost 1.51%. And as you can see on the daily chart on your screen, this index has fallen on 3 out of 5 trading sessions last week. And Friday was the slam dunk big decline, which took this index below its month-long moving average. And do remember, friends, in this video up here, I have explained to you why Friday's price is extremely important to serious traders. Now, this is a study by a very prominent and very brilliant technical analyst of the 1960s and 70s, Richard Donchian. So do accumulate the age-old wisdom that old school technical analysts have provided us, and we are happier for it. So Friday, what you can see on the chart now is what the slam dunk day on the Bank Nifty showed us. As per Donchian's theory was that bulls are completely spooked out. The reason is in the second last segment in this video. The price is below its month-long moving average, which itself is sliding lower. That tells me that short-term outlook is negative. Coming to the weekly chart, what is immediately apparent is that this chart shows a bearish engulfing pattern with the price still holding above its 25-week exponential moving average. Now, why is the 25-week exponential moving average important? Because it's a 6-month long holding on cost of an average bull. So the medium-term outlook is positive, but only as long as the price is above the average. The average is currently placed at 49,900 level. So watch this as a near-term support. Do remember what I have been telling you, friends. Nothing happens in financial markets without a reason, and the reason itself is almost financial. The second aspect is WYSIWYG. What you see is what you get does not exist in financial markets. And the third part, we traders are brain warriors. We fight, we win, or we lose, all thanks to our ideas. So keep it sharp. Now, why are bank stocks holding out if the news or if the fundamental data is pointing towards a challenge? Because of the weightage. At 34% plus weightage in the Nifty 50, the banking and financial sector is contributing the highest weightage, and not just the highest, it's higher than the heaviest weighted sectors number 2, 3 and 4 put together. Had this weightage not been so high, I would not have counted on banking stocks to be this high. So, as the weekly chart on your screen tells you, that the 49,900 area needs to be watched as a support. Unless the banking sector rallies, even the Nifty will not be able to rally sustainably. Friends, in the week before last, this index was number 6 on the most volatile counters list as per a statistical beta rankings that I maintain in-house. It slipped one notch. Now hold your breath. From what you've heard from me earlier, when volatility rankings go down, the challenge level is supposed to have gone down. True. So should you celebrate that the Bank Nifty's volatility ranking has gone down? Hey, no, don't pop the champagne yet. The volatility ranking has gone down on the Bank Nifty because individual stock volatility ranking has shot up, and that is what I see in a statistical trading model. So overall volatility is higher than what it was last week, but because stocks are more volatile, Bank Nifty's ranking has come down. So there's a hidden message here. This market is about to get tricky. Now, last week, I advocated an estimated range between 52,775 on the upside and 49,925 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I estimate a range between 52,000 on the upside and 49,150 on the downside. Friends, in addition to these levels, please also monitor the daily, weekly, and monthly pivots that I share with you on our free Telegram and WhatsApp channels, and keep yourself up to date with daily, weekly swing and intraday trades in options and futures. Friends, the Bank Nifty done. I now come to the Nifty 50, and as the daily chart on the screen tells you, this index lost 1.52% on a week-on-week basis, and it rose only on 1 out of 5 trading sessions, and it fell after clocking a new high. That means at higher levels, sustainability was very, very poor. Now, the price has closed above the month-long moving average, which itself is pointing higher. So the short-term outlook is positive, but only for now. The weekly chart on your screen shows a bearish engulfing pattern exactly like the Bank Nifty. And remember what I have been sharing with you in my live mint column since many, many weeks. Here is one of the screenshots of my live mint column. That banks must rally being a swing segment in the market. Friends, this column is India's first and only media column to offer statistical data to its readers. It's free to read. There's no paywall, no subscription required. So give it a shot. I share the hyperlink on my Telegram and WhatsApp channels every Sunday night or Monday morning. The price is still significantly higher than its 25-week exponential moving average, which is a proxy for a 6-month long holding on cost. There are two inferences to be drawn from here. Because the price is above its 6-month holding on cost, the medium-term outlook is okay. But because the price is significantly higher than the 6-month holding on cost, it means there must be some mean reversion. Either it will result in consolidation, price going sideways and the average catching up, or the price falling and then getting support at the average. So the outlook that seems to be optimistic, but let's be a little careful out there. Hacienda hedges, tail risk hedges, as I have been saying in this video, still are a must. A breakout above the 25,350 level, which would be the all-time high, is a must before I think that the Nifty is able to rally sustainably. Friends, in the week before last, this index was number 8 on the most volatile counters list. It fell very sharply by 8 notches to number 16. Now here again, it's no cause for rallying or no cause for celebration. Basically, stock volatility has gone up far higher and faster than the Nifty 50's volatility, which is why the ranking has gone down. So here again, additional weight of evidence that markets are in for turbulence. Last week, I estimated a range between 25,800 on the upside and 24,650 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I estimate a range between 25,425 on the upside and 24,300 on the downside. Friends, I now come to the last bit of statistical analysis wherein I share the retail risk appetite as found on the footprints of the traders by way of their contribution in the 4 F&O segments. Index futures turnover contribution fell by 3 basis points. It shows as a blue line on the weekly chart of this turnover contribution. Stock futures contribution fell by 49 basis points. It comes as a red line. Now, do remember that these futures are capital intensive, demand a lot of span margin and mark to market margins, and are higher in volatility than options. So, the fact that futures turnover contribution fell tells me that risk appetite was poor. Now, in the relatively lower risk option segment, the lowest option risk is in index options. That is the only segment that grew in terms of turnover contribution. The turnover contribution went up by 1.11%. It's shown as a green line. And stock options, their turnover contribution fell by a whopping 59 basis points, shown as a purple line. So net friends, risk appetite fell very, very sharply. Not a good sign at all. Now friends, I come to that segment which I promised you was all about why are the markets falling. Friends, check out what I have shared with you on 24th and 25th of August on my Telegram channel, because the WhatsApp channel wasn't open then. Here, the first thing that I'm sharing with you is Times Group's report on automobiles. What you are seeing is that inventory levels in the auto sector have gone up to 75 days worth of equivalent of unsold cars. Maruti has taken the lead in actually going easy on production. There are reports of 75 days worth of inventory piled up, and the number of cars could be as high as 7 lakh unsold vehicles. Then Financial Express shared an article on the very next day which says that high inventory is not just in automobiles, but it is across the board in many industries. Now, these are 2 points that I raised as fundamentally worrying points on my Telegram channel on 24th and 25th of August. Now, that's the fundamental reason. Do markets go on fundamentals? Yes. But do remember what I said in these 2 videos. Markets are currently counter-cyclical. They are ignoring all kinds of fundamental data, both positive and negative. And after 2024 is over and out, especially after the US elections are done on 5th of November 2024, there's a very high probability of pro-cyclical markets starting in 2025. Then markets will react more and more to rational news. The emotional charged behavior which people are displaying at this point in time will basically be replaced by rational behavior. Traders like you and me who depend on logical, mathematical, statistical or behavioral trading models to basically trade the markets. You'll suddenly find that our signals and our systems are getting more profitable. That's pro-cyclicality for you. Will there be signs even in other segments of the markets? Yes, there will be. Even your statistical models will start showing you telltale signs. Bear with me, please. I had told you in my earlier videos that markets are in weak hands, and I had proved to you with statistical data. Listen to what I have said in this video of 3rd August. A huge amount of MWPL has built up in the last couple of months. Now here again, because MWPL has built up, emotional and financial capital is invested, panic will also possibly be the highest. And that's not all. I followed it up on 24th of August with this video. So the ticket size per trade has fallen for many days in a row, along with the MWPL rising. It seems to me that the positions that are being built up by the retail guys. So I think it's time to be careful out there, because the retail hands are not really very strong as compared to institutional and high net worth individuals. So if there is any bad news, they would basically head towards the exit door and cause a great deal of volatility. Friends, do remember that not only did I tell you that markets were in retail hands, who are the weakest hands, and therefore they trigger a lot of volatility, I also shared a new indicator called the churn indicator. I shared how to compute that indicator both in an earlier video and also in the community message in YouTube and across my social media platforms, especially a Telegram channel. So you can see how to calculate the churn ratio for each and every of your individual stock, both stock and index futures, as well as delivery based investments. So what worries me is that the churn ratio has gone up significantly. I'll share a couple of charts with you about these. Now, what it tells me is that when the churn ratio goes up, smoke screens are created by the high net worth traders, by smart money, big money operators, call them who you want. They suck the retail traders into traps, which I have said in these videos on pro-cyclical markets, as to how counter-cyclical markets trap traders and pro-cyclical markets basically start rewarding rational and mathematical traders. So that is happening, and typically when the market tone and tenor is changing, volatility is extremely high, which is what you will see. Point number two in why markets are falling: beta clustering. Now, what is beta? Pure price volatility. What is clustering? Coming together in clusters, in small packets. 4th of June, election result day, huge beta. 23rd July, budget day, huge beta. Then very recently, we had a big slam dunk day, huge beta. And then on Friday, which was 6th of August, 6th of September, I beg your pardon, although not as big as budget day or as the election result day, but the beta was definitely big. What are you making or inferring out of this? Hey, the retail guy is not geared up to handle this kind of volatility. I gave you an example of a stock that I had shorted before the election result day. The stock had fallen 25% in one day on the election result day. Do you think an average retail trader can hold on to longs, pay mark to market and ad hoc margins, extreme loss margins, concentration margins, in addition to span margins, hold on with these long positions, roll them over to the next settlement, pay cost of carry, and say, okay, I weathered the storm? But in spite of that, month on month, these stocks are coming down. So there's a mark to market loss even after cost of carry as well. Now, this is something that non-market participating perma bulls don't understand from the point of view of us traders. When you deploy your money, when it's your money on the line, when on your snapquote window, you are seeing real-time profit and loss being flashed in front of your eyes. Believe me, the pressure it can have on a trader is not exactly something that any and everybody can handle. So a churn ratio, and point number two, beta clustering. Now, economic data is also turning top heavy. Remember what I've told you about the interest rate sensitive sectors: banks, NBFCs, and companies that are depending on EMI based sales. Consumer goods, automobiles, real estate. Ring a bell? Auto, inventory piling up, not selling. See real estate stocks, prices are falling. Why? Because they need to sell on EMIs. How many people buy these products outright with a single check? You know the drill. Now, friends, I share with you the churn, the latest churn chart of the Nifty 50. Do note the blue line is the Nifty itself, and note how it's basically formed an arch and falling downwards. The red line is the churn of the Nifty 50. The green line is the churn of the overall broad market. My question to you, as somebody who wants to be an optimist, is I have nothing against optimism. Please go out, it's your money. But if you're going to be an optimist, at least deploy Hacienda hedges or tail risk hedges. If you still want to say, I want to do away with Hacienda or tail risk hedges, I just want to go out there, buy, and buy, because everybody seems to be saying so. My question to you as a logical guy who believes in mathematics rather than emotions is, why is the churn ratio so high? Which means, why are smoke screens being created on the Bank Nifty where the churn ratio is hitting a period high? Why is the churn ratio in the entire market going higher? Number one, because the churn ratio can't be created by retail guys. It means there is bigger ticket size per trade per lot, which retail can't do because they lack the money. Why is MWPL going up when churn ratio is going up? That means the retail guys are buying and the big money guys are offloading, which is what MWPL seems to be going up in very tiny bits, which hints of retail buying rather than institutionalized buying. All right. Why is it happening, and why is statistical beta and standard deviation hitting new highs? Now, standard deviation is a metric of volatility which is nearing crescendo levels. It's not talking, it's screaming. Why? We thought 2 standard deviation was enough for any kind of a market. Now I'm seeing 3.5, or even higher standard deviation on some counters. Hey, I'm going to be careful out there. I don't know about you. You want to take this advice? Fine. But at least deploy Hacienda hedges. So the churn ratio is basically telling me that all is definitely not well. Now I repeat, please do not trade unless you're keeping your Hacienda hedges in place. Friends, I now come to my strategy of what I would do in the coming week. I would continue to trade small. As I have said in this video, you can actually make more money by trading small because you can wait for bigger price swings. This is a market where statistical beta is going to be high, the churn ratios are high. So why risk too much money when you can make the same amount of money on smaller exposure? So Hacienda hedges will be in place. I will continue to be in public sector units. They're going to give me, or at least I expect them to give me, very large two-way moves in either direction. So I will remain focused on these. Also remember that MWPL on these counters is extremely high, where traders are going to face the highest amount of pressure if prices start to fall as rapidly as they have been falling in the last 3 or 4 weeks. So this is where I would basically hunt for the small and weak and slow deer, like I've said in a previous video. You should be hunting for the weak deer. In addition to PSUs overall, what I would focus is on public sector banks, naturally interest rate sensitive. Oil marketing company, because hey, oil's in focus, and I have been telling you there is no super cycle. I'm sorry, I cannot control my amusement, but all these super cycle theories that I have been facing since the last 3.5 years, and I've been debunking on my social media accounts, including videos, etc. In spite of that, the kind of mistakes that are being made of super cycle believers is not exactly very funny. It's really tragic as to how much mark-to-market losses have been going on there. Now, oil marketing companies, power and energy sector stocks are other segments. I will remain bearish, and justifiably so, on energy in the commodity space. And what I would do in addition to non-linear theta decay, I would also go out there and go into linear strategic trades. And my outlook on the long-term bullish theory in Bullion is still remaining in place, and the expected US election time, which I have said in this video on Bullion, is that of high volatility, which is seen every 4 years. Past the US elections, I expect Bullion to start going up. But do remember, when there is excessive amount of volatility and big declines in markets, traders need to pay mark-to-market losses, margin calls, etc. At that point in time, they sell everything, including Bullion. And then initially, after everything falls, then a trend determination starts in earnest, and that's what will happen to Bullion also. Last week, I said the month end was over, and the short covering that typically comes in every month end in metals on commodity exchanges will cease. And sure enough, that happened. You saw a slam dunk in copper. I have been telling you there is no super cycle in copper, and there you have it. Copper and aluminium and other metals have fallen very, very sharply, and that means the stock prices of metal mining companies will face the heat. Friends, in this coming week, don't take your eyes off the advanced decline ratio in real time of your trading terminal, and on the MWPL and churn ratio of your traded stocks. each and every single trading day. Now we have 115 days left for 2025 to usher in. Let's get ready for the pro-cyclical hysteresis in financial markets that I have talked about in my 2 videos on pro-cyclicality. I hope you see them. If not, see them again and again and familiarize yourself with what's in store for us. If there are any more ideas that I want to update you with, I'll be very happy to share them on our WhatsApp and Telegram groups. Thank you for being with me in this video. Before I sign off, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment segment, do let me know what you think of my work and how I can help you become a better trader. Also, please share my videos with smart guys like yourself so I reach out to a wider audience. I wish you have a very, very profitable week ahead. Take care. Bye-bye.